So we'll go ahead and get started. It's about 10 after. We won't take up all of your time tonight, but we did want to introduce yourself. I am Amanda. I am the owner of the Music City Lifestyle Group. I've been in real estate for about 8 years, a little over 8 years now. I have a legal background, and I do about $8 million in sales a year, give or take. And Whitney is my lead agent. Whitney, you want to introduce yourself?
Yeah, I am Whitney Koski, and I'm originally from Memphis, Tennessee. My family and I ended up living in New York City for about 5 years for some stuff that my daughter was doing, and then ended up, instead of moving back to Memphis, we moved to Nashville. So we have been in Nashville for about a year, and I am lucky enough that Amanda has let me join ranks with her because she is the best at what she does. Robert can attest to that. So
I try really, really hard. Like our whole goal is to just always lead with kindness, be able to answer questions, and educate the public regardless of whether you use us to purchase a home or not. Obviously, we hope you will use us to purchase a home, but at least we know we've done all we can do to educate you into guiding you into buying your new home. That way you don't go into it blindsided. So what we're going to do tonight is we're going to do a quick overview of some first-time home buyer programs and kind of what different types of programs look like and different scores for those. And then we are going to go over the timeline of what happens throughout when you're searching for a home and when you should start looking. It's going to vary depending on like when your lease is up or if you already own a home, etc. So we'll jump right in. So the first time home buyer programs, the one that people generally jump to when they are when they're talking about first time home buyers is the FHA program. FHA is a government-backed loan program that allows you to purchase a home with 3.5% down to a 580 credit score, or 10% down to a 550 credit score. That program is backed by the federal government, which, like we talked about earlier, means you will be paying a monthly private mortgage insurance that says that if you ever default on your loan, the government will buy it back from the bank, which is just another protector for big banks. Personally, I don't know how y'all feel about big banks. I don't think big banks should have protections like that, but they do. So that's where we're at. We do have some unique programs in Tennessee that are not FHA programs. The THDA program, for example, is the Tennessee Housing Development Authority, and they can give up to $7,500 toward your down payment or your closing costs. We'll talk about the difference later. If you have a 640 credit score. So it's not free money. It is a grant. You do have to pay it back. However, it's a 0% interest loan. So your payment won't go up very much. We also have other conventional low down payment programs like 0 down conventional loans, 1% down conventional loans, 3%, 5%, 10%, 20%, etc. Those tend to come with a little bit higher credit score, but they tend to come with a little bit lower rates. So it really depends on where you're at. And then we've got things like USDA, which is a 0 down loan program, but it is only available in certain parts of the state. So, for example, nowhere in Mount Juliet can be approved for USDA, but everywhere in Watertown can because it's rural development loan. So when we are looking at loan products, what we want you guys to do is just go ahead and check your credit scores so you know where you're at. Message one of us, myself or Whitney, with your current credit scores. That way we can get you into a position of building your credit if that's what needs to happen, or get you ready if that's what needs to happen right away. Does that make sense? Let's see. Other types of loans. You have VA loans, which Robert is familiar with. A VA loan, you have to have been a veteran, active military, or an eligible spouse, which means your spouse has to have passed away in the last so many months, and they were in the military, something like that. I've had military people move over from Guam, where they didn't even see their house until they got here. So we work with all kinds of military. So if you know anyone that was in the military, and they're looking to move, let them know they may want to use their VA loan, because it is a zero down loan, 100% financing, no extra payment on top of that. And that's their right for being soldiers. That's one of their benefits they get. And for their crappy pay that they get. I read online the other day that I can't remember, E1 or something, is they only get paid $1,600 a month. Can you imagine being in the military and only getting paid $1,600 a month? That blows my mind. Yep.
I do have a question. Are there any loan types or like any specifics in terms of teachers? Like
there are some programs out there for heroes, some zero down programs. Most of those will require a 620 to 640 credit score. So there are some loan products out there specifically for teachers, medical professionals, EMTs, firefighters, police officers, etc., that are not the VA loan. Yeah, they are what we call an in-house product. So that's another one of those lingos that we'll be posting about in the group, things that you might hear. In-house product means that the loan officer that you're working with has a specialty loan product that they can offer you that other loan officers cannot offer you. So that's what in-house means. Let's see. So let's go over with some other costs that I want you guys to be prepared for when you're going to buy a house. Number one is your earnest money. We collect earnest money before closing within 5 days of your agreement being agreed on. And the way I like to explain it is it's a good faith deposit. So essentially, a title company will hold it, or the realtor's office will hold it. It's in a non-interest bearing account because that's against the law in Tennessee. And it is just there to let the seller know that you are purchasing this home in good faith. You have every intention to purchase this home, and you're not going to walk away for no reason. Now, in addition to that, there are contingencies that you will have built in that you can walk away and you will be able to get that earnest money back. If you don't walk away and you make it all the way to closing, then the earnest money becomes either a part of your closing costs, or if your closing costs were paid, then you'll get that back at closing in the form of a check. So that is one of the costs associated with purchasing a home that you guys need to be prepared for. The second cost, and let me give you a price range. That can be anywhere from $250, $500 to $5,000. It really just depends on how strong you want your offer to be. If there are 18 offers on a property and you need your offer to be really strong, then the more money, the better. But if the property's been on the market for 30 days and you're the first person to make an offer, then throw in $500. The likelihood of you getting that money back is like 99%. 1% of the time, maybe, the sellers will sue to keep the earnest money because somebody walked away without one of their contingencies. That rarely happens because there are so many built-in protections into the contracts that we use for our buyers.
Robert's like, yep.
Yep. All right, closing costs. In addition to that earnest money, we want to talk about appraisal and inspection and closing costs. An appraisal, here's what an appraisal is. An appraisal is an opinion of value by an outside source that uses local comparable homes within a certain radius. And that appraiser will provide a report to the loan officer or the lending company to let them know that the house you're purchasing is worth as much as the loan that you're taking out. So if the appraisal doesn't come back, for example, if it comes back low, then at that time you either have to renegotiate or the seller has to drop the price, or you can go your opposite ways and you'll get your earnest money back. It's pretty rare that one comes in low right now unless the house is just way overpriced. But that could cost you anywhere from $500 to $700. So be prepared for that expense as well. Next, you have the home inspection. Your basic home inspection is going to cost somewhere in the range of $350 to $450. You want to be prepared for that. This is another contingency that you have. So if, say, you get that inspection report back and it says, this house needs foundation work, the beams are broken, blah, 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 and the owner does not want to fix those things, then you walk away and you get your earnest money back. You will not get the cost of inspection back. So that's important to note. The reason
that inspection happens within 10 days of
Yeah.
the contract.
Generally within 10 days. If you buy new construction or something like that, a lot of people waive the home inspections. I never suggest to waive a home inspection, even on a new construction. Main reason being is houses are man-made and men make mistakes. So, you know, I've had new construction inspections that came back and the hot water the line was ran wrong. So you should just always get an inspection. But there are multiple different kinds of inspections. Just your basic home inspection between $350 and $450. Now you've also got radon inspections, termite inspections, all of those other things, which we will go over with you when you get pre-approved to see if you want to get those additional inspections. The termite inspection is likely to be required. It's about $50. So there's another expense that's coming out right out of the gate. Your last expense for buying a house that's going to come out of pocket are your closing costs. Well, we went over appraisal, inspection, termite, closing costs. So here's what your closing costs include. They include the setup of your escrow account. Your escrow account is like a savings account that you pay into every month. And then when your taxes become due, when your homeowner's insurance become due, your mortgage provider just pays that for you since you've been paying in every month. So that is part of your closing costs, the setup of your escrow account. The first year of your homeowner's insurance required in the state of Tennessee. You've got to pay the first year of your homeowner's insurance. Any prorated taxes. So as you know, every home has property taxes. When you purchase a home like in July and property taxes are not due until October, then you only pay a prorated amount of taxes. So the seller will give you a credit from January to July. Does that make sense to everybody? I lost my train of thought there for a second. Closing costs, that's where we were. You can estimate these between 2 and 3% of the purchase price. That typically will get you everything you need. Now, you'll notice that those can't get very high. Closing costs are negotiable with the seller. However, we have to keep in mind the landscape of the real estate market that Nashville is in right now. You've seen the news stories. You've heard your friends talking about it when they're going to buy a house and there's 10 offers on the house. Your offer will be less strong on a multiple offer situation if you have to ask for closing costs. So the more you can have saved up, the better, even if you don't need a down payment, even if you're getting a 0 down loan. If, for example, Robert just bought his next house. He got the closing costs paid. We were able to negotiate that because the house had been on the market, 2 weeks? Something like that.
Yeah, it was on the market 15 days, but I believe we went above asking to cover the cost. So I gave her a full, essentially what I did is I gave her full asking, but on paper it said 7,000 more because I asked her for the closing cost because I went VA.
So basically he financed his closing costs, which is an option as long as the house will appraise. His house appraised, so that was fine. If the house doesn't appraise, then again, you have to renegotiate with the seller. So there are some options where closing costs are considered. We can negotiate, but keep in mind, if there's multiple offers, it may not be a negotiable item. All right, let's go into when you should actually start looking at houses. You need to start, depending on your credit score and depending on your timeline of buying, speaking to a lender as soon as possible. The reason is, Whitney and I were realtors, we can't pull credit, but lenders will pull your credit, and the lenders that we work with are very good about saying, oh, if you pay down this credit card to a balance of $100, then your score will go up by 20 points. So they'll give you all the tips and tricks you need in order to build your score so that you're ready by the time you need to be ready. If, for example, your lease ends in June, well, we don't want to start looking for houses in June. We don't even want to start looking for houses in May. We want to start looking for houses in April. So let's say you find a house in April, you close in May. June will not be your first payment. Your first payment will not be until July. So you've got that cushion where you can still pay your rent for a month without having to pay your mortgage and not have to pay extra to get out of your lease. So we really want to start looking, getting you pre-approved 2 to 3 months before your lease ends. Because our goal, right, is to not let anybody be homeless. We don't want you to be homeless, you know? And so apartments, especially once that lease ends, if you have to go month to month, they jack up your rent so much. We do not want you to be in a position where you can't afford that, which is why we make sure you know up front that you have that 1 month cushion. So if we close in June, your lease is up in July, that's going to be fine because your first payment isn't going to be due until August. Any questions surrounding anything I've already said? All right, I'm going to share my screen real quick. Y'all don't laugh at me about how many tabs I have open. Oh, it's not even that many.
That's a good day.
I know, this is a good day. I'm going to open this so that I can show you guys the timeline. This is in the group, or if it's not in the group, it'll be in the group tonight. Is it in the group, Whitney?
It is.
Okay.
It's under the files. I updated it today.
I'm going to let Whitney go over this with you guys and just kind of explain how it all works and answer any questions you might have around it, if I can get it open. It's just opening all kinds of different tabs.
I know.
What is
Should have
happening?
shared my screen. There we go. Just, that's good. All right, so like Amanda said, the first step that we're going to talk about doing is to get pre-qualified with a lender. If you are not at a point right now where you can be pre-qualified, we still want you to be talking to the lender because the lender is going to be the one who's going to say, these are the steps that we need to take in order to get you to the point that you can be pre-qualified. Once we have you pre-qualified, that's when we're going to set you up on what's called an auto notify. So we're going to sit down, we're going to talk about what do you want in a house, number of bedrooms, do you want a house or do you want a condo where the HOA is going to take care of the maintenance and the grounds. We're going to talk about square footage and do you want a yard? We're going to go through all of the different questions to try to narrow down your search so that we're not sending you a bunch of houses to look through that just really don't apply to you. An app that we are going to recommend that you have is an app called HomeSnap. A lot of people like to send us listings from Zillow or from Trulia. What we can tell you about those is that they are not attached to our MLS and they are more often than not very outdated. So you will find something on Zillow that says that it is still active and I will go and look on my end and that house has been under contract for a week. So we don't want you guys wasting a bunch of time on your end or finding a house that you fall in love with only to find out that we say, no, it's under contract. At that point, once we start to go look at homes, another step that we have not put in here, but that we are going to do is we're going to sign some paperwork, a buyer's rep agreement, which just means that Amanda and I can negotiate for you and write an offer for you on your behalf. Then when we go look at homes, when you find the one you want, it's going to be time to make an offer. We will give our best estimate of what we think is going to make your offer the strongest. There are going to be instances where we do get into multiple offer situations. That's something we're going to cover in another meeting. Once you have put in an offer, a lot of times what we're going to have is what's called a counter offer, where we're going to say, okay, we'll pay $350,000 for this house, and we want you to give us $5,000 towards closing costs or whatever it is. And the seller's going to come back and they're going to say, you know what, we're only going to pay $2,000 for the closing costs. We will counter back and forth, negotiate back and forth. Once we reach an agreement that everyone is happy with, that is what's called the binding agreement date. So you'll see on here, you'll see the word BAD. That just means binding agreement date. That's your contract date. That's when you're under contract, okay? At that point, that's kind of when the clock starts ticking. So within usually 5 days, you have to have that earnest money over to the title company. Then we will order your inspections based on what we decide you need in terms of inspections. Then we will get the inspection report back. We will go over the inspection report with you. Another meeting that we're going to have for this group, we're actually going to show you an inspection report, show you what it's going to look like and how we go through it and how we make recommendations along with the inspector on what we think really needs to be fixed in this home. After that, you will get the appraisal. The lender is the one who orders that. We will then wait for the appraisal report to come back. Like Amanda said, as long as the appraisal comes back at or above that contract price, we're good. If it comes back low, that is when we have to go back and negotiate again, okay? Once we've done all of that, we will do repair negotiations, which is that's when we're talking about that inspection report. There's a leak in the roof. There's some electrical work that needs to be looked at. Those sorts of things will go back and forth, come to an agreement with the seller on what you guys are going to be willing to do and what the seller is going to be willing to do in terms of making those repairs. 1 to 2 days before closing, we're going to go back to the house and do a final walkthrough. We're going to have that report from the inspection and the agreements we came to about what's going to be fixed. And you and I are going to walk through the property and make sure that those changes were made. We're also going to make sure there's nothing that has changed about the house since we saw it and put in the offer, because a lot of times there's at least 30, 40 days in between those two. So you want to go back through, make sure nothing's, they didn't leave a hole in the wall when they moved out, those sorts of things. We're going to do that. And then at the closing table, we say you're going to sign 9 million documents. It's not really 9 million, but it feels like 9 million. The title companies are great about saying, this is what this piece of paper is. This is what it means. This is why you're signing it. Here's what you need to be looking for. You're going to sign everything. At that point, we give you your keys.
So it sounds easy.
The process.
It sounds easy, but let's talk about a couple of things that we need you to know. Once you get approved, the lender is going to give you a pre-approval and they may say, okay, you're pre-approved for $300,000. We want you to understand that that $300,000 can be variable. And the reason it can be variable is because your pre-approval is based on usually a single family home with no HOA. an estimated homeowner's insurance, and an estimated taxes. Okay. So if you buy a house that has extremely high HOA, or you're trying to buy a house that has an extremely high HOA, and you were only approved for 300 and the HOA is 250 a month, then you will not be able to afford the $300,000 payment on the house. It'll be about $250 over your pre-approved amount. So it's really important that you guys communicate with us when you see a home that you like, so that we can make sure you are still approved for that home before we go see it. Now, many times we're going to know just from experience whether you'll be approved for that home or not, and we're going to be able to tell you. Sometimes we may have to send it over to your lender to get approval, but the majority of the time, just know that number is variable and it's highly dependent on whichever property you choose. So make sure you're communicating with us, because if you get a $300,000 condo in your email and you want to go see it, we check it and realize that the HOA is $200. We don't want you to be disappointed when we tell you you can't afford that one. Unfortunately, the HOA is just too high. So make sure you're communicating with us.
And with the lender.
Yeah, and with the lender.
And like when they ask for something, the sooner you can get it to them, the sooner we can keep the process going. So we just don't want to hit a standstill because the lender's waiting on stuff.
And also the agreements that we're going to sign with the seller, they are legally bound agreements, which means you have a legal responsibility to meet the deadlines that are provided in your documents that you've signed. So if you do not order the appraisal within 14 days, then we need to be constantly asking where the appraisal is, because it's per the agreement, you are legally bound to order your appraisal within 14 days. So I think what a lot of people don't understand is that when you are in a contract, it is a legally binding document and it is enforceable by a court of law. So you can't just walk away for no reason. You have to use one of your contingencies. Now, there are tons of built-in contingencies that we're going to write into the contracts on your behalf as buyers, because that's what we do. We love buyers. But make sure you don't just ghost us, because if you just ghost us, then you risk losing that earnest money that you've put down. We don't want you to lose money. That's not our goal. Our goal is to put you in a home so you can make money by living in a house, right? You should never lose money in real estate. Secondly, the pre-approval letter. You may get one pre-approval letter from one lender and then decide, I feel like this is a little bit high based on other rates. Once you have gotten that pre-approval letter, or once you've applied for a loan with that lender, you've got 14 days exactly to apply for other loans and it not hurt your credit. On day 15, if you apply for another loan, it will be another hard credit pull, and hard credit pulls make your credit scores go down. So you get one shot. Apply for the loan, and then you can apply for as many more as you want within the 14 days. But don't go a day after, because you can mess up your credit score. We've seen it happen. Some other things to note. Make sure, you would think we wouldn't come across this often, but we do. You have a bank account that's open. You have to have a bank account. It can be an online banking account, but it still has to be a bank account that is backed by the FDIC. So bank accounts, credit scores, applying with different lenders. What else are we missing? Oh, what do we do? Well, we're realtors, right? So we find the properties. We take you to see the properties. I know a lot of people think we're just glorified, door openers, but I want you to understand that you are going to, just the purchase and sell agreement is 10 pages long. We're going to go over that with you. We're going to tell you what everything means. We're going to explain to you what earnest money is, what inspections are, how many days you have to do everything. And that's just the purchase and sell agreement. There are about 12 other documents that are multiple pages long that you'll have to sign that are required by the state of Tennessee. So we're going to go over all of that for you. But most importantly, we're going to know how to fill all of this stuff out for you so that you aren't stuck doing it yourself, right? So many people we hear, well, why can't I just buy one myself? Why can't I just go to a for sale by owner and buy it myself? Well, you could. Don't get me wrong, you could. Is that for sale by owner that's not being represented by a realtor going to have access to all of the documents that Tennessee requires? Probably not. Could you get in a situation where you don't have a contingency to back out if you don't like the way the home inspection looks, or you don't like what happens to the appraisal if it comes back too low? Those are things that you have to watch out for. I have helped people before that went to go purchase a home for sale by owner, and that scenario that I just gave you actually happened. They had an inspection, they wanted to back out, they were legally bound to that contract because there was no inspection contingency in the contract. They ended up buying that house and taking a $20,000 hit because as soon as they moved in, they had to get foundation corrected. So that's not what we want to happen. We never want you to be upside down on your loan or, negatively impacted by your loan. Always positive impact by your loan. That's our goal. Really, the way I explain it to first-time homebuyers, it's kind of like a forced savings account. When you purchase a home and you make your payment every month, some of it goes towards interest, don't get me wrong, but that mortgage payment, when you sell your house in 5 years and you've got $100,000 in equity and you've only spent $20,000 in a mortgage, you just got paid $80,000 to live in your own house. That's the goal, right? To always make money. This is an investment in yourself and in your future. This is how you build generational wealth. This is why it's called the American Dream, because it is the easiest way to build cash flow as an adult. Just owning property. They won't make more land, right? They can't. In fact, we'll probably lose more land. Once California or Florida kind of, moves out to become its own island, we're going to be losing land. So we always want you to know that the goal is to build wealth by owning real estate, not lose money by owning real estate. That is definitely not the goal. So that's what we do. When we get into an offer, it's multifaceted. So yes, we know all the contracts like the back of our hands. New construction contracts, we'll go over that in a later class, but it's completely different than what the contracts are that we usually use.
They're like 60 pages long.
They're like 60 pages long. Yeah, they're huge. And then when it's time to make an offer, by signing that buyer rep agreement with us, you've essentially said, I'm allowing this agent to negotiate on my behalf. So when we make an offer, we're going to do something called pulling comps, which means we're going to look at other homes in the same area that have sold to make sure that you're paying a fair price for that house. You're not overpaying, you're not underpaying, unless, it's time to negotiate because it's been there for a while, but you're paying a fair price, because our goal really is for it to be a win-win for everybody, but we still work on behalf of the buyer. The longer the home sits on the market, the more negotiation power. One of the biggest complaints I hear from first-time home buyers in our market is, I thought I would have more room to negotiate. And the reality is, your good deal right now is coming from interest rates, not from home prices. It's just hard to negotiate when there are multiple offers on everything. So we're going to run those comps. We're going to make sure you're not overpaying, but know that we have your best interest in mind. So it might be a situation in which, we get the inspection back and we don't really need anything, but maybe we should ask for $1,000 in closing costs. But you'll already be in contract. So it's important to know that there are things we can negotiate later, But up front, if you're in a multiple offer situation, you have to put your best foot forward if this is the house that you want. Robert, did you have a question?
No, I have a comment if I'm allowed to make one.
Sure.
So a couple of experiences I had. My first real estate agent was not as good as Amanda. Not all of them are created equal. I fired 3 lenders before I went with the one I have, and now the one I have has written 4 loans for me. 3 refinances on a previous property that I could not wait to get rid of, and he's writing the loan on my house, which I close on the 4th. So shop lenders. They're not all equal. They're not all great. Some of them do suck. Some of them you will fire. So that is one of them. Second one, home inspection. Read that report. My first home, and not all home inspectors are created equal. My first home inspector, I sued his ass. So read the report, understand it, go through it, because you do not want to be in a situation like I was, where you move into it and you're spending $1,700 fixing plumbing, another $800 fixing a roof that no one knew about. So really pay attention to it. Those are my 2 comments, if I'm allowed to make them. Just some things I learned by hating life. The home, Amanda and I, when we were going through this home buying process, we put an offer on a house, did a home inspection. The house is 3 years old, had foundation problems. I said, screw you and a goodbye. I got my earnest money back and backed out of the contract because I was allowed to. So she's not lying when you can do that kind of stuff. And then she actually found the house that I'm sitting in. I'm renting it from the seller. So she's not wrong in what she's saying, folks. But home buying is fun. Selling a house, not so much. But it can be as great or as shitty as you allow it to be. And not all real estate agents are created equal. Amanda, I just happen to know her. She's a friend of mine and wouldn't use anyone else. Hence my investing comment at the beginning of it, because she's going to help me with an investing property. Where the one I had first, he was great, but he really didn't pay attention to what I was wanting. So, all right, I'm going to shut up now.
Robert's exactly right. We're going to know these things in and out. We're going to know the ins and outs of buying a home. We want you to ask questions because we want you to go into the process educated, which is kind of the whole point of creating this course, right? Whitney and I were sitting down one day and we're like, what can we do to give people the education that they need to buy a house without them feeling like they're being forced into it? Because so many times and so many agents are just in it for the money, right? We know that. Realtors have this rep of being like very used car salesman-y. That is exactly the opposite of what my team wants to be for you guys. We want to be your resource. We want to help you out with inspectors and handymen and lenders and anything that you need before you start the home buying process and after you finish it, because we want to be there for you forever. We do not want to force you into a home. We are going to give you accurate costs associated with it. We're going to look at comparable sales. That way you're not overpaying for a house. Now, we may have some other suggestions. We may say, here's the deal. I think it's priced too high, but there's 3 other offers. So we need to go in at this price. And then after inspections, maybe we can negotiate a lower price. Will that always happen? No, but at least it's an option that we can talk about. So our whole goal with this course is just to educate you as much as possible. We want you to have enough knowledge to be able to share with other people going through the process, whether they use us or not. We want you to have enough knowledge to be able to know what you're doing when you're going through the process, whether you use us or not. Because ultimately, what happens is if you go into buying a house and owning a house inexperienced and without any knowledge, that's how we got 2009. We don't want to see that happen. This is my career. This is what I chose to do. I love doing it. I don't ever want to be in a situation where someone is calling me saying, I way overpaid for this house and now I can't afford my mortgage because I had a balloon mortgage and now I'm paying 20% interest. And even if I sell it, I'm going to have to bring 30 grand to the table. I don't want to see anybody that I've ever met go through that. So that was the purpose of this course. And while it's going to seem long and drug out as we put more information up and it's going to seem like it's slow moving, The goal is to make sure everybody understands everything clearly before you get into, home ownership, because home ownership, it's a great thing, right? Again, like I said, you build generational wealth, you get out of renting, you pay your own mortgage. Eventually, when you sell that property, you are able to put money in your pocket and buy another property. At the same time, if you are not educated, you could end up overpaying for a house. You could end up not having contingencies to back out. So there are all kinds of things that could happen. Our goal is to make sure your home buying process is flawless and you're completely educated in the process. So it's about 10 till 8, which we said we were going to leave the last 10 minutes open for questions. Throw some out there.
We know we just threw a lot at you. We know that was like drinking from a fire hose. We know. And so,
Question.
yeah.
Okay, what is it?
So with you guys saying all these costs that we should expect out of pocket, what do you think is like a good amount to have like saved up before starting?
The very minimal amount that you should plan on having is around $2,500.
Okay.
And that is assuming that we can get your closing costs paid.
Mm-hmm.
Now, if you're going to also pay your closing costs, I would much rather prefer you have between $600 and $7,500 saved up so that we can use that. But minimum $2,500, which is not hard, right? Every time you move into a new apartment or a new duplex or whatever, you've got to pay the application fee. You've got to pay the deposit, first and last month's rent.
Yeah.
So $2,500 bare minimum.
Okay.
So working with someone who is rebuilding credit, like what has been the time frame that you've seen for them to buy a home?
So it really depends. Everybody's situation is so unique that it really depends on each unique situation, which is why we want you to check your credit and let us know so we can get you to a lender, match you with a lender as soon as possible. Now, I have seen lenders pull some magic tricks out of their hat, y'all, where I sent them to them with a 580 and 6 months later, they were at a 650. So it really just depends on several things. How many inaccuracies are on your credit report? 70% of credit reports have inaccuracies. Really, all you need to do for that is just dispute the inaccuracies and they'll remove it. They'll automatically go up. Now, if you have things like repossessions or evictions, those are things that the older they are, the less they mean. The newer they are, the more they're going to impact your affordability and your ability to purchase a home. If you have an eviction in the last year, you're probably not going to purchase a home in the next 3 or 4 years, unless you pay it off and you have a legitimate reason. There are exemptions to lots of things. So, for example, I'll tell you this right now. When I was 22 years old, I had a repossession. I had wrecked the car. I had totaled it. I didn't have car insurance. I was a child. I know we don't think of 22-year-olds as children, but in my opinion, I was a child and I had a child. I had my daughter when I was 17. So I was a broke single mom. I wrecked my car, totaled it, had no insurance. I got a repossession. When I went to go buy my first house at 27, I was able to tell the lender, write a note to FHA and say, here's what happened. Here's why I didn't have insurance. Here's the situation I was in at the time. And I was still able to get a loan, even with the repossession on my credit. So everybody's situations are different and unique. So there are exemptions that can take place with just a single letter sometimes. If you had an eviction, I had one client who had an eviction on their record. There were 4 people living in the apartment. It was a 4-bedroom apartment. The apartment was in all 4 people's names. She paid her portion, but the other 3 did not. So the eviction was still showing up on her credit. Well, she had the receipt. We were able to submit the receipt for approval from FHA. So again, dependent on situations. I know that doesn't help give you a timeline, and I'm sorry.
A good lender will tell you. Like the
Yeah.
lender I use, he'll tell you what you need to do. They'll tell you if he's a lender worth a shit, he'll tell you. I promise.
They will. They'll give you step by step. This is what you need to do. This is what we're going to do first. And it really like trusting the lender and doing what they say.
Imperative.
It's imperative. And it really, the clients that we have that do that quicker are the ones who, like, we have clients that are about to close that 8 weeks ago, they were like, we still need some time. And then all of a sudden we have, you know, they do 3 things and it's a game changer.
Yeah. And the lenders that we work with, they will never say no. The worst they're going to say is not right now. Like, it is never our goal to say no. We don't want to work with lenders that say no. There are lenders out there who will be like, no, I won't help you. Your credit score is too low. We don't work with those.
We don't work with those.
If you're not ready right away, then we make sure the lenders that we work with, as well as ourselves, are checking in with you monthly to make sure you're doing the tasks that you need to do. Now, we can't do the work for you. We can't go on to Experian Boost. We don't have your social security numbers. We can't report the inaccuracies on your credit report. We cannot do the work for you, but we can help hold yourself accountable to yourself. Does that make sense? So we're going to check in every month. The lenders are going to check in every month. And let's see. Whitney, when did we give the last girl? She was at a 600 about 3 months ago. It was right before Christmas. And
Yeah. And we're shopping right now.
yeah, she's shopping right now with a 640. So her score went up 40 points in 3 months based on doing what the lender told her to do. So like I said, we can't do the work for you, but we can help hold you accountable. Cool. Do you have any other questions?
So each month, oh yeah, go ahead, Andrea.
So like I have student loans. Does the lender take that into effect of like how much of a loan you can get for your house?
Yeah, like we said at the beginning, different loans have different overlays. So it depends on what kind of loan you're going to use. FHA, for example, is the 3.5% down that we talked about. And they require you to report 1% of your total student loans as a payment. So I don't know, what is 1% of $5,000, $50, right? Yeah. So you would have a $50 payment, which would bring your debt to income ratio down. There are other loan products that do not use the 1% rule. Some of them can go off income-based repayment plans. Some of them can go off deferments. An income-based repayment plan is always going to look better than a deferment to a lender. So even if you have an income-based repayment plan that shows you as paying $0, which that does happen a lot, more often than what you would think, it still will look better than a deferment of $0 on your credit. Because an income-based repayment plan reports on your credit score as an on-time payment, even if it's $0. And a deferment reports as a deferred payment. Does that make sense?
Yeah. So like now, since they like stopped the student loan payments, does that show up as a deferment or does that show up as like whatever it was before it happened?
It's showing up on your credit that you're making on-time payments, but it will not be used in the instance of an FHA loan as a $0 payment. It'll still be used as 1% of the total value of loans that you have out.
Uh-huh.
And that's something else that we didn't really touch on tonight, but your debt to income ratio is essentially the amount of money that you bring home every month minus the amount of debt that you hold. So your home mortgage has to be under 50% of the amount of income you make every month. That 50%, if you don't have any other debt, can just be full 50%. So if you make $3,000 a month, you can afford a $1,500 a month mortgage. But if you make $3,000 a month and you already pay $1,500 in loans every month, they're going to decline your mortgage because it looks like you cannot afford a $1,500 a month mortgage or any mortgage because your debt ratio will be above 50% of what you bring home every month. Does that make sense to everybody?
That makes a lot of sense.
Okay. So paying down your loans as much as possible is important. Credit cards, a credit tip here is if you have credit cards or loans, the lenders really love and credit companies really love for your balance to be 30% or less of the total amount of value. So if you have a $100 credit card, it's going to maximize your score if you only spend $30 or less every month. You never want to max out your credit cards. 30%.
Robert,
Yeah, I ain't gonna lie. I had credit cards maxed out when I bought this house.
you're the class clown.
I don't anymore, but I still did.
Well, now he had to pay his credit cards off in order to buy the house.
Yeah,
So-
I paid most of them off.
Yeah, he was able to do that with the proceeds from the sale of his old house in order
Like I
to
said,
buy
my other house drove me broke because I didn't know what I didn't know.
I have a question.
Yeah.
So if you have credit cards, do you need to have them all paid off, or do you need to keep a running balance on them, but just keep it low? Make sure it's a revolving balance.
Keep a running revolving balance, but just keep it low. You can have it paid off to zero.
Right.
That still shows as a revolving loan, but don't close your credit cards. If you have credit cards open, closing them will hurt your score more than help it.
But what if you have like 8 of them and you just want, like myself, and I just want to get rid of a couple because they're just too many? Why would like I have some that have high credit limits, and then I have smaller ones that I just got just to have them to start my credit, but the balance or the credit limit has never increased, so they're just like $300 here, $300 there. But if I don't really want those and I want to keep the ones that have like a $2,000 credit limit, is that going to still hurt my score if I just get rid of the smaller ones?
Yes, you don't want to close them. Just pay them off to zero and just don't use them. Pay them off to zero because the amount of credit you have open plus the length of credit, the length of time is what makes up your credit score.
Okay.
So if these cards are older cards, even if it's low balances, then they are reporting a positive on your credit score. When
Okay.
closing them would report a negative.
Yeah, they all show my payment history is on time. They're all in the green.
Yeah. So if you close it, it will hurt your score because of that length of time that is included in credit scores. And then once
Okay.
you buy your house, you can close them because
Gotcha.
once you have a mortgage, that makes up like 30% of your credit score from here on out.
Gotcha.
Any other questions around credit?
Yes, we're just being transparent. So we did file for bankruptcy back in April of last year. And just like we told ourselves that this year we're going to raise our credit score up. Well, I mean, it's not bad. I guess it's bad. It's like high 500s. One of mine is reaching in the 600s, but like, what is your advice for, people in that situation?
So was it chapter 7 or chapter 13?
7.
Okay. So essentially you just kind of were able to erase all your debt, but it really negatively impacted your credit score, right? So we need to rebuild your credit score by opening small credit limits and consistently using them like Tasha was just talking about. So we don't want, in your case, your credit cards to be at a zero balance. we want them to be used every month and then paid off every month to a really low balance. That way it shows a revolving use of credit.
Gotcha. And my wife, she opened up a secured with Capital One and then added me as the authorized user. Recommended, not what should I open up one myself as well?
If you can, absolutely.
Okay.
And add her as an authorized user. Then you'll be able to piggyback off of each other.
Okay.
And bankruptcies are a little bit different and, beast. If the reason I asked you chapter 7 or chapter 13 means you have to pay most of those debts back, but you're on a payment plan. Mm-hmm. So if you had a chapter 13, then your payment plan would go against your affordability for a house. Mm-hmm. Whereas a chapter 7, you don't have that. So you just have to wait 365 days after your bankruptcy discharge before you can be approved for an FHA loan. Yeah. Now there are loans out there that one day after discharge you can be approved. Most of those require 20% down.
Yeah.
And they typically require higher credit scores. So yeah, I would suggest opening up small lines of credit. Adding people as an authorized user is actually an excellent tip. It's for example, my little sister, when she turned 18, I added her as an authorized user to my credit cards. And she never had access to my credit cards. She never spent anything on them, but she was able to then copy my credit history onto her credit in order to have a really, really high credit score at just the age of 18. And by 22, she was a homeowner. So if you don't want to do it with your spouse, if you have a mom or a dad or a brother or sister who has really excellent credit, ask them if they'll add you as an authorized user, because you can borrow their credit without it negatively impacting them at all. You get the positive impact. They don't get any negative impact. Doesn't affect them.
Thank you.
All right. Do we have any other questions? If not, then Whitney and I are going to go home because we've been at the office since 9 this morning. But we are going to post this video in the group. We want to encourage you, if you are about to go to sleep and if you're like me and you try to lay down and everything is running through your head at night, go ahead and post in the group, because if you have a question, it's very likely that somebody else in the group also has a question. So we want to encourage you to ask questions on the wall in the group so that we can answer them in real time. Obviously, if we're asleep, we'll get on the next morning. And we also want to encourage you to reach out to any friends or family that you might know that also may be looking to purchase a home and may benefit from this course, and send them an invite to the Facebook group. We're going to give each member 2 free invites. So remember, we kept this very exclusive. We didn't want it to be huge. We were very purposeful in that. We wanted to be able to get to know you guys' faces, get to know you by name. We wanted you to do the same with us. So we'll extend 2 invites. If you know anyone, please invite them. And we'll see you guys next month.